You've decided to start investing. You open the app, you're ready to go, and then you freeze. There are thousands of funds, hundreds of tickers, endless opinions, so most people do nothing. In the last two videos, we covered why to invest, compound interest, and why simple index funds beat most professionals. Today is the how. By the end of this video, you'll know exactly how to build a complete, diversified starter portfolio from scratch using just a handful of funds in a way the world's most respected investors actually recommend. No jargon, no guesswork. Let's build it one piece at a time. First, the word portfolio sounds fancy, but it just means everything you own as investments grouped together. Think of it as one big basket that holds several smaller baskets. The whole game of building a good portfolio comes down to one idea: diversification. That's a long word for a simple instinct. Don't put all your eggs in one basket. If you own a single stock and that company stumbles, you're in trouble. But if you own a slice of thousands of companies, no single failure can sink you. The losers are outweighed by the winners. That's why we don't pick stocks here. We buy broad, low-cost index funds, each one already holding hundreds or thousands of companies. So the question isn't which stock, it's which baskets and how much of each. That mix is called your asset allocation, and it's the single most important decision you'll make. Here's the beautiful part. You can build a complete, globally diversified portfolio with as few as 3 funds. Index nerds call it the 3-fund portfolio, and it's been popularized by the Bogleheads, the community inspired by Vanguard founder John Bogle. Here are the 3 building blocks. 1. A total U.S. stock market index fund. In a single fund, you own a piece of essentially every public company in America, large, medium, and small. This is your growth engine. 2. A total international stock index fund. America isn't the whole world. This fund adds thousands of companies across Europe, Asia, and emerging markets, so you're not betting everything on one country. A common guideline is to put around 20% of your stock money here, though reasonable investors range from 0 up to 40%. 3. A total bond market index fund. Bonds are loans to governments and companies. They grow slower than stocks, but they're steadier. They're the shock absorber that softens the ride when stocks drop. That stability is exactly why we include them. 3 funds. Thousands of holdings, spread across the entire world. That's a real diversified portfolio. And it costs you almost nothing in fees, just like we covered last time. The only question left: how much goes in stocks versus bonds? This is where your age and your nerves come in. The more time you have, the more stock you can hold, because you can ride out the dips. The less time you have, the more bonds you want to protect what you've built. A classic rule of thumb: take a number like 110 and subtract your age. That's roughly the percentage to keep in stocks. The rest goes in bonds. It's not a law, just a sane starting point. Meet Maya. She's 25. 110 minus 25 is 85, so about 85% stocks, 15% bonds. She has 40 years ahead of her, so she can afford to be aggressive and let the market's ups and downs play out. Now, meet Daniel. He's 55, about a decade from needing this money. 110 minus 55 is 55, so roughly 55% stocks, 45% bonds. He still wants growth, but he can't afford a deep crash right before he needs to cash, so bonds carry more weight.
Same 3 funds, just different proportions. As you get older, you gradually shift the dial from stocks toward bonds. That's the entire concept of allocation by age. Pick the split that lets you sleep at night and stay invested, because the worst portfolio is the one you panic sell at the bottom. Okay, you've picked your funds and your split. Now, do you invest all your money at once or spread it out over several months? Spreading it out has a name: dollar cost averaging. You invest a fixed amount on a regular schedule no matter what the market's doing. Here's what the research says. A Vanguard study found that investing a lump sum all at once beat spreading it out about 2/3 of the time. The reason is simple: time in the market. The sooner your money is invested, the longer it can compound. But, and this matters, investing everything at once can be emotionally brutal if the market drops the next week. So, if dollar cost averaging is what keeps you calm and consistent, that is completely fine. For most people just starting out, the honest answer is even simpler. You'll be investing a piece of every paycheck anyway, which is dollar cost averaging by default. The best strategy is the one you'll actually stick with. So, let's turn all of this into action. 4 steps. 1. Open a brokerage account. Most major brokerages are free to open and have no minimums. If you have a workplace retirement plan with a match, start there first because that match is free money. 2. Choose your 3 funds: a total U.S. stock fund, a total international stock fund, and a total bond fund, each with a rock-bottom expense ratio, ideally well under 0.1%. 3. Set your allocation using the age guideline as a starting point, then adjust for your own comfort with risk. 4. Automate it. Set up an automatic transfer every payday and turn on automatic investing so the money buys your funds without you lifting a finger. Then, and this is the hard part, leave it alone. Rebalance maybe once a year. That's it. And that's a complete starter portfolio. 3 funds, an allocation that fits your age, and automation that keeps it running while you live your life. It's not flashy, it's not exciting, but boring, diversified, and automatic is exactly what builds wealth over decades. You don't need to be an expert. You just need to start and stay in. If this gave you a clear plan, do me a quick favor. Hit the like button so more people find it. Share it with someone who's been meaning to start investing. It might be exactly what they needed. And subscribe, then turn on notifications by tapping the bell so you don't miss the next one. One more thing. Tell me in the comments which money topic you want covered next. I read them all, and they genuinely shape what we make. Next up, we're tackling the accounts themselves. The first 5 accounts every young adult should open and the order to open them in. Any links in the description may be affiliate links that support the channel at no cost to you. Thanks for watching. Now go build your basket.